Two people, same bank, same Tuesday morning. One waited 26 minutes on hold about a $34 fee. The answer was no. She rearranged her grocery list on the drive home. The other one got called first. His private banker had an investment opportunity, not publicly available. He had until Thursday to decide. Same institution, same logo. Different numbers, different worlds. So here's the one question nobody answers clearly. At what exact point does a bank stop charging you to exist and start competing to keep you? 6 levels. One system. Here's exactly how it works. Before we go level by level, understand one thing. A bank does not treat every account the same way. Every balance sends a signal: risk, stability, and value. The same institution can feel completely different depending on what number appears next to your name. Level 1, $0 to $10,000. The survival zone. A warehouse worker brings home $1,700 a month after taxes, rent, utilities, her son's school supplies. Her account hovers between $80 and $400 most weeks. One evening, a streaming subscription she forgot to cancel charges $12.99. Her balance dips $3 below zero overnight. She doesn't notice until morning. By then, the bank has already processed it and added a $34 fee on top. She now owes $47 for a service she doesn't use. She calls the number on her card. 26 minutes on hold. The fee stands. A review is available. 3 to 5 business days. That delay costs her. A medical copay she planned for Friday bounces. Another fee. She spends the next week recovering from an error that started at $3. Here's what the bank would never say out loud, but every internal model already knows. Accounts below roughly $1,500 in average balance cost more to service than they generate. Infrastructure, fraud monitoring, customer support, those costs are fixed. The interest income on $200 sitting in checking is essentially zero. So, the overdraft fee isn't punishment. It's revenue replacement. The bank is recovering the margin it can't earn any other way. In 2024, US banks collected over $12 billion in overdraft fees, concentrated almost entirely on the accounts already closest to zero, and the credit available at this level reflects the same math. If an offer arrives, it's a secured card requiring your own money as collateral, with rates in the mid-20s. The bank is pricing for maximum default risk. You aren't invisible to the system. You're just classified as expensive to serve and inexpensive to lose. Level 2, $10,000 to $50,000. The stability zone. A high school teacher starts setting up automatic transfers of $150 every paycheck. 18 months later, his balance crosses $12,000. He didn't switch banks, didn't call anyone, just let the balance grow consistently without interruption. The first thing that changes, the monthly maintenance fee disappears. No letter, no announcement. The system detected a stable balance and steady deposit pattern and reclassified him automatically. Then the credit offers shift. Not a secured card asking for collateral. An actual unsecured card, $6,000 limit, 12 points lower in interest than he would have seen 2 years earlier. He didn't negotiate for it. The bank moved its position based on what his account history demonstrated. This is the shift that matters most, and it's almost never explained. The bank isn't responding to his income. It's responding to the signal that income consistency sends. Regular deposits mean predictable behavior. Predictable behavior means lower risk. Lower risk means a cheaper loan. One the institution is more confident making. On a $22,000 auto loan, the rate difference between level 1 and level 2 can be 6 or 7 percentage points. Across 60 months, that's several $1,000s in extra interest, paid not because one borrower is more likely to default, but because one hasn't held a balance long enough to demonstrate otherwise. The system doesn't reward who you are, it rewards the pattern you've established. Level 3, $50,000 to $250,000. The valuable customer zone. A general contractor spends a decade reinvesting every profit he earns. No staff at first, just him, a truck, and discipline. By year 9, his combined deposits sit near $190,000. He doesn't call the bank calls him. A relationship banker reaches out with a direct number and a specific request. 30 minutes to review his accounts. Not to sell a product, to ask questions about his timeline, his expansion plans, whether his personal and business accounts are structured efficiently for tax purposes. The banker had already reviewed his deposit history before dialing. Below this level, you go to the bank. Above it, the bank begins coming to you. The shift is economic, not personal. At $50,000 to $250,000, losing a client is a measurable line item on someone's internal performance report. A relationship manager's purpose is to prevent it, and the tools they carry are real: fee reversals, rate adjustments, credit approvals that bypass the standard queue. The contractor gets a business credit line that autumn at a rate that would have been unavailable 3 years earlier. His collateral hadn't changed. His relationship value had crossed a number the institution takes seriously. Banks compete hardest for the customers they can least afford to lose. At this tier, that calculation finally includes you. Level 4, $250,000 to $1 million. The preferred client zone. A couple sells their HVAC business after 20 years. $760,000 lands in their account on a Thursday afternoon. By Monday morning, someone with a title they've never heard before has reached out. Not to pitch anything, to ask, what are their goals? When might they need access to the money? Have they spoken to a tax advisor about how the sale interacts with their retirement? For 20 years, they submitted loan applications. Waited on hold, they were moved efficiently through a queue. Now the institution wants to understand them. A client holding $750,000 in liquid assets represents potential advisory fees, investment relationships, and asset-backed lending, revenue that compounds over years if the relationship holds. Losing that client is expensive in multiple directions simultaneously. So the bank doesn't just assign better service, it assigns a person whose professional purpose is not losing them. On a 30-year mortgage, a half-point rate difference compounds into tens of thousands of dollars, invisible to a neighbor filing identical paperwork at the same branch the same week from a lower tier. Level 5, $1 million to $5 million. The wealth management zone. At $1 million in investable assets, something fundamental changes. Not just how the bank treats you, how it thinks about you. Below this threshold, banks see deposits. Above it, they see a balance sheet. The difference is almost everything. An aerospace engineer sells a property portfolio she spent a decade building. $2.4 million in liquid assets, spread across accounts she always managed herself. The conversation with the wealth division isn't about products. It's about architecture, how the money is structured, what it's doing, what it isn't doing that it could be. Tax-efficient account organization, estate planning as a long-term strategy, access to investment vehicles, private funds, structured products, instruments with six-figure minimums that simply don't exist in any retail banking interface. She also learned something nobody told her in 15 years. Wealthy clients at this level don't typically sell assets to access cash. They borrow against them. A low-interest credit line secured by her investment portfolio lets her fund a new property purchase without closing any position, keeping her investments compounding while she deploys capital where she needs it. The interest rate on the line is lower than the capital gains tax she would have owed by selling the same amount. That strategy isn't a secret. It becomes accessible when the collateral base is large enough for the bank to make the arrangement worthwhile. Below this level, the math doesn't work. Above it, the offer appears, not from generosity, but because the advisory revenue on $2 million, grown over a decade, far exceeds any service cost the institution bears to keep her there. Level 6, $5 million to $20 million, plus, quote, the private banking zone. There are parts of major financial institutions most people never reach, never encounter, and that aren't designed to be found, unless you already belong there. A software entrepreneur exits his company in his early 50s. $13 million. He didn't seek out private banking. Private banking called him within 48 hours of the transaction settling. The private banker who called manages fewer than 35 relationships in total. Not customers, relationships. The distinction matters. A customer implies a transaction. A relationship at this level implies a long-term arrangement with significant institutional stakes on both sides. Loan terms here are not published. They are discussed. Interest rates aren't generated by a pricing model. They're negotiated in conversation. Investment opportunities arrive before they're open to any public fund. When the founder needs a large wire reversed, one he authorized in error, someone answers before the second ring and resolves it within the hour. That same reversal, at a lower tier, takes days and multiple escalation requests. This is what the tiered system arrives at in its final form. It is not the bank that becomes extraordinary above $10 million. It is the economics. A client at this level represents enough deployable capital and enough potential lifetime revenue that reorganizing an entire process around them costs the institution far less than losing them ever would. The private banker isn't providing exceptional service because he is exceptional. He's providing it because the math demands it. The system, unchanged. The warehouse worker and the software entrepreneur use the same institution, same routing number, same logo on the wall, same legal entity. What's different is not the bank. What's different is what each person represents inside the bank's internal model. One is a cost the institution absorbs. The other is a relationship it would restructure itself to protect. The fees at the bottom aren't cruelty, they're math. The service at the top isn't generosity, it's also math. Every tier between them follows the same logic, not values, not fairness, just the consistent calculation of what your account generates versus what it costs. And the compounding effect runs in one direction. The worker paying $600 a year in fees isn't only losing $600, she's losing a decade of growth that money, invested consistently, would have produced. The entrepreneur receiving waived fees and early investment access is gaining compounding advantage, not because he worked harder, but because the starting number unlocked a different version of the same institution. But here's what the structure doesn't explain, and what most people never find out. The thresholds are knowable. Consistent direct deposit eliminates maintenance fees at most major banks, regardless of your starting balance. A modest cushion past the minimum balance requirement stops the overdraft spiral entirely. And once you understand how clients above level 5 use credit as a growth instrument rather than a rescue from shortage, borrowing and saving stop looking like opposites and start looking like two tools in the same strategy. Your bank already knows exactly what your balance is. It already knows which version of itself to show you. The real question is whether you understand what that number means to them and what it's costing you not to.